Imagine this scenario. You're back in your childhood neighborhood, setting up a collapsible table with your parents as you discuss pricing for this ridiculously delicious lemonade you plan to sell. Your younger sibling grabs 2 lawn chairs and sets them up for both of you to happily sell your thirst-quenching beverage to all prospective customers. A few hours pass, and your only customer was your older sibling and your friendly neighbor. Of the $200 you needed to raise to purchase your brand new Nintendo GameCube, only 50 cents were sitting in your red Solo cup with "Pay Here" written on the side of it. So you decide to close up shop. As you begin to collapse your table, you start thinking about how to properly restructure your liquidation to ensure it complies with the Internal Revenue Code. After all, you're not the average 7-year-old. But the task is still daunting. Your limited knowledge of tax, combined with the complexity of various rules, drives you to seek out help from professionals to assist you with ensuring you leave no stones left unturned. Hello everyone, my name is Andrew Underdown, representing Group 3 of Professor Hurley's Tax Research and Planning class. Myself, Emma Engel, and Peter Hempstead will be discussing the method we believe is the least complex given a fair liquidation for our client, Premier Tax Accountants Incorporated, who plans to liquidate by the end of May 2022. And just to keep things simple, we'll refer to Premier Tax Accountants as PTA. While not all aspects of our solution will be discussed in this video, we would like to present our findings with respect to which laws are most applicable to our situation, along with a court case that helps us determine if we are in a status of liquidation. Now, let's get started. When in a status of liquidation, the United States Internal Revenue Code, or just simply the Code, gives a few specific rules to follow to ensure no one is evading nor paying an unfair amount of tax. First, let's take a look at Section 331, which tells us how to handle distributions to shareholders when a liquidation occurs. The code literally states amounts received by a shareholder in a distribution in complete liquidation of a corporation shall be treated as in full payment in exchange for the stock. This doesn't immediately tell us much, so I'll refrain from using literal code statements from now on. In fact, it's often easier to turn to Treasury regulations for guidance. Treasury regulations, or more simply regulations, give a more thorough breakdown of the code. The regulation that relates to Section 331 is Regulation Section 1.331-1, which tells us that when a corporation distributes cash to its shareholders, the amount the shareholder receives will either be a gain or a loss. Much easier than what the code says, right? With respect to your lemonade stand, if you decide to distribute a portion of the 50 cents you earned to your sibling will have to recognize a gain on that amount. Of course, this is assuming his basis in the corporation is less than the amount of cash received. The code section that relates to this is Section 1001, which states the amount received minus your basis is the gain or loss you will receive. Now that we have a good grasp on Section 331, let's take a look at another important rule involving transference of property. When liquidating, corporations don't always distribute cash. Sometimes it is appropriate to distribute property to a shareholder. In that case, Section 334 informs us that the basis the person receiving the property has in said property will be the fair market value of the property at the time of the distribution. Tying this back to your lemonade stand, say you decide to distribute the lawn chair your sibling used to him for $10. If the sibling has a basis of $4 in the chair, then those $4 will be the new fair market value of the chair. In this instance, the code tells us in Section 336 that a corporation will have to recognize a gain or loss on the distributed property as if it sold the property to the shareholder. That means your lemonade stand will recognize a gain of $6 upon this transaction. But what happens when there is a liability attached to the property? Again, the code, in Section 336, tells us that the fair market value of the property won't be less than the liability assumed. If you were still paying off your chair and the attached liability was, $7, then our fair market value would instead be $7 instead of the $4 mentioned earlier. Finally, let's talk about what it means to be in a status of liquidation. In 1984, a U.S. tax court in Delaware formulated a 3-pronged test in the court case Olmsted v. Commissioner. The first prong is the manifest intent test. Essentially, this test clarifies whether or not you intend to liquidate given the language of your liquidation plan, as well as the existence of said plan. This rule is relatively straightforward, but let's begin tying these rules back to our actual client, PTA. PTA has 3 key events in their plan that satisfy the manifest intent test. First, PTA will not engage in any new business activities. They just recently picked up a client, but they've also stated this will be their last client. Second, PTA will cancel all stock, and any stockholders won't have any rights to voting. Finally, PTA will dispose of assets after shareholders have granted approval. Now, let's move on to the second prong. The second prong is the continuing purpose test. This test shows a continuing purpose to terminate corporate affairs and dissolve the corporation. In other words, from the effective date to the date of liquidation, the decision to liquidate must remain constant. Since PTA has only just begun their liquidation process, it is hard to determine their commitment, but it can be assumed that they will be, based on the language of their plan. The third and final prong is the activities test. This test shows whether the corporation's activities are direct to the purpose of terminating corporate affairs and dissolving the corporation. Sounds very similar to the second test, right? Well, the key difference is whether or not the corporation is actually carrying out these activities. Luckily, PTA satisfies the 3-prong test, so we can continue forward structuring our liquidation. In conclusion, we can see liquidation is a bit intimidating at first, but they're pretty manageable after taking a bit of time to understand what you're getting yourself into. If the process of liquidation intimidates you, don't stress it. You know that distributing cash to a shareholder results in gain for the shareholder. You also know that property distributions to shareholders result in a recognized gain, or loss, to the corporation, meaning you can distribute that lawn chair to your brother for profit. Regarding the rules for determining if you are in the process of liquidation, just remember that you really gotta make it clear that you intend to, will continue to intend to, and show that you intend to liquidate. Now, I think it's time you kick back and play that new GameCube your parents bought for you anyway. You deserve it.